Good morning, everybody. Welcome to the Flow Show, Tuesday, the 5th of August, and a fairly quiet morning to kick us off. As you can see from the screen there, I want to remind you, anyone who's wasn't in yesterday or hasn't been following on the socials and whatever, we've got a free risk management webinar being run by the team on Thursday. All you need to do for that is to sign up to our newsletter, and I shall pop the link in the Zoom chat again today, right there. So sign up there. If you've already subscribed previously to the newsletter, don't worry. You would have received your link from the newsletter on Sunday. We will send out a separate email with the link to that webinar. You will need to register for the webinar. Okay, so first of all, you can sign up for the newsletter, but then we send you a link to the webinar because it's an invite only. You will need to register for the webinar as well. The time of the webinar, I think off the top of my head, it is around 16.
London.
Yeah, 1600 UK time, London time, I think. But all the details will be in the webinar registration. Yeah, 4 p.m. UK time, exactly, Gav. So that's the time of it. So get in quick, because if you don't get the link, you won't get in the door. And just before I move on as well, just to make you aware that we also have our summer sale on, where you can get 40% off a monthly subscription. That's running for a few weeks. So we had a big take up at the last sale. So if you want to get in to the Forex Analytics platform at a decent price, then you can do so with a 40% discount. And once you get that price, you will keep that price for as long as you subscribe. We won't be bumping your price up 2 months down the line. So you get to keep that price, as I say, for as long as you subscribe. Oh, all that done. Morning, Kate.
Morning, Ryan. Morning, everybody. All well today? And are you going to the hairdresser to look good for the webinar, Ryan?
I'm going to get the polish out. That's my trip to the hairdresser these days. You got any? I ask if they got any turtle wax, and give me a good old shine up. So yeah, wear your sunglasses. But, I don't know. Is it videos? Are we doing videos? I don't know.
Actually, we should ask confirmation to Blake. Yeah, I don't think. Well, I mean, it's going to be a bit of a fire chat style, I think, and no, it should be extremely interesting, because we are going to probably people listening to the webinar will have like a quite wide how shall I say, overview of the possibilities how to manage. So it's going to be a bit of a chat thing. Maybe people have a Q&A session as well, where they can ask us a few questions. But no, it's going to be extremely interesting. There's not going to be, I think, any how shall I say, official presentations or so. It's more going to be a discussion and a friendly overview of what all of us are doing. Michael just saying that he's very interested to know what shirt you will be wearing, Ryan. Don't wear anything too bright, okay? Because then people will only have your shirt on the screen all the time, Ryan.
Too late. I'm already thinking about my attire already. I'll have to pull something out the woodwork. But yeah, and I've just thought I'm gonna do something. Okay, we're gonna have the webinar on Thursday. Friday's Flow Show. I'm gonna ask you questions. I'm gonna question you lot and those who watch the webinar, to make sure that stuff's sunk in. So I'm gonna have a few questions to ask you. A bit of revision, shall we say?
Brand, and Brand, no need to sign up every day, okay? You are already signed up yourself.
Yeah, but do register for the webinar, which you can find in the chat room. If well, you're in their Brand, so yeah, you'll need to register for the webinar itself. Okay, the link was in the newsletter, and Blake posted it last night as well. We'll rehash that, and as I say, another email will go out too. Right, let's get cracking. and what's been going on in markets and the news. Over in Japan, PM Ishiba says the US trade deal must be implemented swiftly, and there's no point in a trade deal without implementation. He even went so far to say that an agreement doesn't necessarily have to be on paper, and talks with Trump can be face-to-face or on the phone. So we would push back if US tariffs went back to 25%. Japan's Akazawa, the trade guy, is off to visit the US again because he wants to push for the swift auto tariff implementation, and said tariff coordination is needed before the August 7th rollout. So the clock's ticking, and Japan putting the pressure on the US to get all this stuff done and dusted. An advisory panel to the Labour Ministry has proposed raising the average minimum wage by 6% this fiscal year, which would be higher than prior years. And the fact they're pushing for this fiscal year shows that they want, or they're advising that the government pushes those average wages up, the average minimum wage up by 6%, which will be music to the BOJ's ears, amongst others. What isn't such good news is that the Cabinet Office is apparently going to revise down its growth forecasts for this fiscal year. They were set at 1.2% in their January forecast, but that's set to come down amid all the tariff trade shenanigans going on. A bit of good news, a bit more good news for Japan. Australia is apparently going to buy 11 naval frigates from Japan for a deal that's around 6.5 billion US dollars. 3 of those will be built in Japan and the rest will be built in Australia. We did have a bit of data out. It's PMI day. Finals for some of the countries, a lot of the countries. Japan posted a decent number for services, 53.6. So that's looking tickety boo. Manufacturing not looking so hot as it has been, but it's services day today. Moving on into Europe, we got Spain services out as well. That blew the doors off, coming in at 55.1 versus 52.6 expected. Italy, that improved, but a slight miss on expectations there, 52.3. France, these are the final numbers. They went backwards, 48.5, after the flash number went up a pip. And as has been mentioned on Twitter, we don't usually see such big revisions in these PMIs, but they're swinging about quite a bit at the moment. Germany services, they improved to 50.1 in the flash, and they improved further in the final to 50.6, the pan-Eurozone number, pretty much reflecting the modest rises across the board. UK as well saw an improvement, 51.8 over the 51.2 flash, though it's still down a point on last month. Pretty much not much to trade on all these numbers, but the details, there's some details that stick out. For example, the UK saw the fastest round of job losses since February. Germany saw the biggest decrease in inflation pressures since 2021. So that all plays into the potential central bank trade, if you like. We obviously have the Bank of England Thursday, and that jobs data has been running pretty rubbish for the last few months. So that's not good news from the PMIs there. We'll see whether that's going to affect the Bank of England and their ruminations on Thursday. For Germany, they're putting some of this back of the sofa money to work. The German armed forces have awarded Rheinmetall, shock, to supply over 1,000 logistics vehicles, the total order exceeding 770 million euros, and that's for delivery in 2025. Back to the UK, the government's low pay commission has a central estimate, or has issued a central estimate, that the minimum wage will need to rise by 4.1% in 2026. We're still going to be seeing some pay deals coming through the public sector this month, I think, which could impact the jobs numbers and add a little bit more inflationary pressure to the UK and Bank of England, but they're revising another 4.1 rise next year. Kay, anything of note from all that? We had the minutes out from the June BOJ meeting, which is a bit pointless because we've just had the July meeting. But things ticking along. Another wage hike potentially on the cards.
I think they can demand it because in yen terms, a lot of those companies have posted record profits, as we have seen on past fiscal year. But the issue with that is that it's mostly due to yen being weaker, that their profits have been bumped up so much. So not sure if the companies are going to swallow those rate hikes because they will have to take into account this new trade deal where they are going to have to make some concessions, whether and we've already heard from a couple of them saying that they may actually lower their prices for their goods or cars to counter some of those 15% also tariffs that the US is going to has slapped onto them. So I'm not 100% sure that they are going to get their 6% demanded. But if so, that would be, of course, great news for the Bank of Japan indeed. For the rest, moving on for those European PMIs, we know that Spain is still outperforming all the rest. The rest turns, has to be said, apart from France, the rest is turning right above that 50 line, which is the expansion line. So we are not going to be too gloomy about those numbers. They are above the 50 line, as I said. The other one that stuck out overnight to me was the where the Aussie services PMI as well. They came in at a pretty strong 54.1, so that's not a bad number at all. We know that RBA has their meeting next week. This is not going to be really the decider. We have seen the inflation number coming down, right, and a pretty flatlining job report, if I recall correctly. So there's still a fair possibility that RBA goes for a rate cut next week, but it's not going to be a panic cut if you look at numbers like those services PMI coming out. That's I think what we can take from the overnight data, and then I'm sure you were going to mention Mary Daly with her comments.
Yeah, that's coming up next. Oh yeah, I missed the Aussie PMIs, and as you can see, the Chinese, the Caixin private survey coming out with an improvement as well. So we are seeing a bit of a pickup in services across the globe. We got the ISM today, so we'll see if that carries the baton as well. We've got that coming out later on manufacturing services from that. Bit of data from yesterday. Factory orders, there wasn't a lot out. Factory orders came in down 4.8%, which was around about expectations. This was following a big month in May. This is all trade related, front money and all that stuff that we saw April, May. This is a bit of a washout, so it's not quite the bad news that it looks like on paper. Yes, on to daily, sounding a little bit more dovish. It seems the NFP has maybe scared a few people at the Fed. She said the time is nearing for rate cuts. Her base case had been 2, but she said we may need more than 2. And then in the story, she said we could, of course, do fewer than 2 if inflation picks up and spills over, or if the labour market springs back. He said, but I think the more likely thing is that we might have to do more than 2. We should also be prepared, in my judgment, to do more if the labour market looks to be entering that period of weakness and we still haven't seen spillovers to inflation. So pretty dovish sounding. That's got Goldman's out. I think they're the first to start calling for a 50 pip cut or putting a 50 pip cut in there. forecasts. They keep their 3-cut forecast for the Fed that they issued back in July, still starting to cut in September. But they do now think a 50 pip cut is possible if the next jobs report shows higher unemployment. So, Kay, I think they're the first ones to start throwing around the 50. No surprise, really. We could probably get a few more of them coming in. The market, the pendulum is swinging once again. Do you think a 50 is justified, even if the unemployment rate ticks up to 4.3, 4.4?
Yeah. So two things. First of all, Myra Daly is a non-voter this year, so she won't press the button for that cut. But well, we know, and we've been talking about that in our news and research room as well with Michael Brown. There is Powell himself has put it on top of the watch list. The jobs market in the U.S. But I've been saying it for a long time. I think that unless we really see inflation ramping higher in the US, there is a case, to me, there will be a case if the jobs market really weakens, that there will be a 50 in there somewhere. Now, is it going to be a string of 25s, 3 of them, or 150, 125, or 150 and that's done because inflation is higher? That is all to me, that's all part of the possibilities, but I'm not going to rule a 50 completely out, especially if we get like another bad one on top of it. If we get the early September jobs report, if that would be bad, then we may be in for actually a 50 BP cut. Now this, we have to put everything in context as well, because Powell has fired the lady who ran the numbers. So who is he? Who is going to come into place? And is that person not going to massage the numbers to the other side? So we may be in for a bit of a surprise to the top side next report. So everything remains to be seen. But the thing is as well, as we were talking about that in our chat room, is I also think that they will want to remain in the Fed, in real Fed funds rate in the positive territory. So and Michael also said that imagine if we go back above 3%, that is going to limit the potential for deeper rate cuts. So we have to take everything into account. But I do think that the jobs market is now on top of the minds, and it does not. I am not going to rule out a 50 bps cut. I mean, everybody is free to think, of course, what they want. People still think that they won't be able to cut because of inflation, but I think if the job market weakens any further, and then we think about, as I said, maybe 4.3 is not going to be enough on the unemployment rate to cut a 50, but print a 4.4, 4.5, then I think that will open the door, because then we will be above the projected range of unemployment, of the unemployment rate at the Fed themselves. That's about it. What I think about it. The door is open, but it could also be 225s, and we will have to see about what's going to come up in the data. But because we still will have inflation and PCE reports as well, of course, before the next FOMC.
Yeah, and CPI I think is next week, and that will throw the cat amongst the pigeons. That's another hot one, which is good because it means we're back to trading data points again, and they actually mean something. Whereas a lot of the times they mean nothing. So we've got a market turning more dovish on the Fed. We get CPI next week. If it's hot, you're going to see them swinging the other way. But probably not as much as if then we get another weak jobs report. So I think on the balance, the scales are tilting more to the dovish side. So anything we get that's from inflation that gives a dollar rally, yields a rally, that might be something that flips around pretty hard if we get another stinky jobs report.
What is also interesting is that for people watching fundamentals, we know uh, a lot of our people in the room and listening to us are mostly technical, also traders. But we always try to look at the fundamental side of things. But this is an interesting switch. It's not going to be the case that we disregard inflation by no means, but the balance of importance or the scale of importance has definitely switched a little bit. Where we were when everything is like zooming along, only inflation was like kind of important and the outlook for it. But now we have seen there's a swing in importance in the data as well, and it's really brought the job market right back to the top end of the ladder, right?
Yeah, absolutely. And on the flip side, if it is a soft CPI number,
Oh
missing
yeah,
expectations, lower CPI than last month, then well,
oh yeah.
September will
Then
probably be 99% by the end of the day.
yeah, 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 absolutely.
And then, and then it all hinges on the NFP, that big massive lottery number. Oof, it's going to be a big old competition next month. Right, let's crack on. If I can remember where I was, we are here. Right, so onto the trade stuff now. The Swiss government is getting a bit antsy. It's planning continued talks with the US and ready to talk after the August 7th deadline if needed. They are determined to make a more attractive offer to the US, but they're not considering any countermeasures at this point. So a lot of countries rushing to get stuff done by the August 7th deadline. US-China are going to resume their trade talks today, so we'll keep an eye out from headlines from that one.
Watch, watch out with that, because if that's based on a Nikkei article, that's a Nikkei article of last week. I think somebody by mistake put that article back up.
Oh, did they? Oh, I didn't even notice that.
If that's the one, because I was actually looking for it because I didn't see I didn't see much elsewhere. We know that they are talking, right? We know that they are talking all the time. But if that was the headline, I went to look for it, and because I didn't think that they were in Stockholm again this week, and apparently it's an article from last week.
Oh, right. I didn't even notice that. Yeah, we'll have to check that out. But, well, we'll keep an eye out anyway. We know they can talk at any moment. Trump has, well, one of the first deals to be put on the cards was a deal with India. And that was set to be one of the first to be signed off alongside the UK, even before the UK one was signed off. And then it's been ongoing, and now the can's been kicked to October. And when they might finally sign something, well, that might be cups and saucers in the air as well, because Trump has said he will be substantially raising the tariff paid by India due to India buying sanctioned oil from Russia. Obviously, the Indian government has reacted, calling the targeting of its country unjustified and unreasonable. And one of their excuses for buying Russian oil was saying that they were encouraged to do so when the Ukraine war first kicked off. That was obviously potentially by the prior administration. So India's back in the spotlight and in Trump's bad books, which could, as I say, waylay the deal that they were working on. US's Hassett says the BLS data has become very unreliable and we must get a fresh set of eyes at the BLS and must modernise the labour data to be transparent. He also said that everybody should bank on tariffs being resolved. Russia, after Trump's putting US nuclear subs around the region, says it no longer considers itself bound by a moratorium on the deployment of short and medium range missiles. That's reported by the Foreign Ministry. I don't think that's really new news because they've been lobbing short and medium range missiles into Ukraine anyway, but they're just repeating that so everyone knows about it. That's it on the headline front, I think. And if you've got anything else, Kay?
That's it. That is it.
Good. That's what I like to see. So yeah, we'll have a quick look at what's coming up from this services PMI data. We are expecting a hefty jump to 55.2 from 52.9. Oh, sorry, that's the services number, the S&P Global one. The ISM number, let's get that right, is expected to jump to 51.5 from 50.8. So a bit more of a modest gain there. Keep an eye on the components as well. Employment has been in the negative, into contraction. Prices paid are still running pretty hot, 67.5. So keep an eye on those two numbers as well when we get that data. But apart from that, and a couple of auctions later on, not much else to talk about on the data front. So we'll keep glued into that. And maybe the week stays fairly quiet. Right, prices wise, what's going on around? Well, I'm on dollar CAD, so I might as well start there. This one holding up fairly well. We've got this little bit of a range developed. I sort of pointed this out yesterday. 37.55s we held yesterday. We're sort of trying to pivot around this 75, 78 level. The main level above we're tapping at the moment, this 138.0010. Need to get back above there and hold there before thinking about a run back to these highs. Probably look for a bit of modest resistance, maybe around the 38.20-25 area, should we get above 38.10, just on the back of some of this price action we've seen here. But otherwise, the dollar's holding in there at the moment. That's also evident in dollar yen, which I'll keep showing in our chat room, is really walking hand in hand with US yields a bit as well. But it has recovered. We had this little blip under. We saw a blip under in US yields as well, under 420 in tens. And then we've got to move back above 420, and we're seeing dollar yen holding 147 again. So this level is still pretty important. We're up tapping this 147.60s level, which has been a bit of seen a bit of action on and off. So running into trouble there. But yields holding, US yields holding these low areas doesn't mean we're going to see the dollar rallying significantly. It just might mean that it's going to stop or go down less fast than it has last week. But watch those yields. We're creeping back up to 430s in tens, going above there. Then you're probably going to see the dollar recovering a bit more. Kay, what's your feeling on the buck? Have we done our Fed reprice now, or just waiting for the next bit of data, or
Yeah.
is there more to be done, do you think?
I am. There will be more to be done if we get a confirmation. We get a like a combination of though maybe a weaker ISM print, especially on the employment index, and then market going to auction, because I guess after such an NFP report and that move that we saw in the yields, we're starting with the threes. These later today, there is shorter term stuff as well. We have the 1 year as well, I think, and shorter ones. But those, I think those auctions will be quite important right now, because we will have a kind of a measure of what the bond market wants to do, what people want to do. If we get some a lot of foreigners involvement, etc. It's going to be an important, or at least a very interesting read in those auctions, and then obviously the ISM services. Until now, we've had the digestion of that NFP report. But it doesn't seem to me that the market wants to go and push to run too short dollars right now, and we are seeing the correction in quite a few things. Well, in most of the dollar pairs, we're also seeing it in gold, for instance. There was this rush into gold. It has calmed down. We are actually even coming down a bit again. The market is not yet convinced to be short dollars again, where it has it has bought quite a few into the end of last week. So I think that's what the reason why we are trading the way we are. Is going to need confirmation of what we have seen last Friday. So I think ball back to neutral, and or the needle back to kind of neutral, and now wait and see what the next set of data is going to tell us.
Yeah, absolutely, mate. 100% agree with that. If you're looking at yield, keep an eye on a 2 year as well. So there's a couple you need to keep an eye on. 10 years, obviously, but 2 years as well, which does sort of, it's a good rule of thumb guide to, Fed rates, at least over the short term. That's down at a pretty important area down here towards 370, 350s. So keep an eye on that zone. If we're breaking under there, then the market is getting uber dovish over the Fed, because this is what, 370. So we're running 68 odd pips below the Fed midpoint at the moment, which is round about where we're at for expectations, 60 odd pips for the rest of the year, 65 pips in cuts for the rest of the year. So it's around there. It's a good identifier, shall we say, compared to US 10s. As I just showed, there's that 10-year yield holding that for 21.
Yeah. There's a lot
Yes, mate.
more. If you look at the 2 years, it's the one where the market builds its expectations on what the Fed may do, where the longer end is what is going to happen with economy, what is going to happen with inflation, etc., etc. It's more like an expectations kind of market if the longer you go, right?
Yeah, exactly. And if you're in our chat room or in our platform, don't forget to check out our handy new tool that we've got in play at the moment. Just trialing that for a while. I'm not going to give anyone else the heads up of what that is, but if you want to know what's happening in the interest rate central bank market, then you check out that tool on our platform. Right, so dolly in, as I mentioned, not doing an awful lot. We have seen a bit of a bounce up from that 147, so it's still a key level there. Let's see if it wants to creep up any more. Ali, you're still on your euro sterling, so that's looking okay for you at the moment. It's not managed to hold. Looking like we're having a move under this 86.90, 87 level. So this zone down here is going to be uber important as to whether we're going to hold the dip or we're going to head lower and go through this low, maybe get back down to 86 on this one. I'm still long. I'm still a bit top heavy. I would have liked to have added a bit down here, just improve the average. But I'm still sitting that way in fairly negative. The UK, so I'm not looking to change my mind on that, and I would add on further dips unless something in the news changes. I'll let Kay look at the Swissy for that one. You're thinking about reversing your trade. Yeah, you could reverse your trade. If you see this 70 level holding, then that's possible that you might get reversed. But just keep an eye that we had that high, we couldn't get up to that high. So just in the very short term, I would not be surprised if we maybe even move down to the bottom of this zone. As long as we didn't break this low in the 86s, I think if you're looking to get long anywhere, from this zone down to the 86 level, looks valid to stay in longs. But where you're going to be wrong if this 86 level breaks. But your trade is your own, my friend. So take it as you will. Not a lot else. I'm keeping half an eye on the old China K because had a little bit of a creep up. It's giving it back again.
China?
Yeah, it's still very much locked up. But could we maybe have a little mooch up to the higher 720s, maybe?
Well, I was thinking that because I said like, oh, keep an eye on that 721.22. We ran right into the 722 and then shied away again. And I think we may still talk about that in terms of trade, depending on what will be decided, clarified. and especially put to paper on between the US and China is going to be important. Trump is clearly in an anti-BRICS state of mind, but China will be the exception to the BRICS rule, I think, because it's just too important. And it's not only important for trade, it's important for geo and even simple politics, because if you think about the um, the overall negative sentiment that the US public also and the rest of the politicians have towards China, it's never going to be an easy one. Um,
Well, one
get
question: if
get
they're going after India about Russian oil, they've got to go after China, haven't they?
Yeah, but can you? Because China is probably, I mean, if you go after China in regards to Russian oil, you can forget it that Xi is going to pick up the phone if you do that. Because but Trump and his administration, of course, desperately need Xi to get Xi on the phone, which hasn't really been the case so far, apart from wishing each other's happy birthday. And it's and they will have to still tread very carefully. But there is obviously this problem, and it's not only Russian oil. It is simply that China is supporting Russia, and since the start of the Ukraine war as well. Remember the story about the Russian trucks being stuck because those Chinese tires were less than good quality, but it's been ongoing since then, and even with, of course, a lot worse than just Chinese tires. So it's going to be a very difficult one, but. Um, Paradoxically, I think if they can put something to paper which is not going to be too bad for the US and prevents China from having to lose face too much, I think then we may have like one round of CNH positivity, maybe down to, I don't know, 710 or even 700, and then the thing is completely going to reverse. And then because then China will have this kind of green light to start exporting again, and then they won't want the Chinese yuan to strengthen, right? But for as long as we don't have anything, and for as long as they're playing tight to the chest, and it's not going to change much. We're completely stuck in the China right now.
Yeah, I think probably the only way we get a trade on in this malaise is if there is a big headline that gives us a spike move, be it up or
Mm.
down, something like this. Probably won't get one as big as that.
Or if
Um,
you know
but
what,
you could,
or if they tell Russia to get to the table, to go to the
yeah,
table. Yeah.
yeah. So I think that might be the only way we get it. Last one before I hand it over, dollar mex. This one's still trucking up. I've been mentioning that this old fib level, this 50 retracement, we've had 3 goes at trying to get through it and can't. It's given it the springboard to go up towards the highs. Again, we've just saw this little step down of the highs at the moment. So we need to get above this 1895 before we can think about the 19. Keep an eye on this 1880, 82 level. If we get a dip down there that holds that would be potentially bullish signal. But I think if we got a fourth test to this 1877, that would look a bit dodgy, and another move under might be the one that then carries on going. So this one's a bit of a coin toss at the moment. It needs to go and have a crack at that 19 level, and we know where it needs to hold to do that, and we know where things might turn around if not. So I'm keeping an eye on that one. If it gets above that 19, I'm probably and hold. I'm going to fold the rest of my short, but I've built up a bigger long position into that 1850 anyway. So onwards and upwards, as far as I'm concerned, for that one. Right now, let's see if I can get this over to you this time.
Mhm.
I think I have to do this
Yep,
and that.
got it.
Okay, that's worked. Cool.
We're there.
Yeah, with that.
Okay. on the Swissy, Ali, what have you got? You're short dollar Swiss. What is it? Short dollar Swiss. Okay. It's all about trade still. It's a bet on trade right now. We know that Switzerland yesterday said that they may try to sweeten the deal for the US. That is not going to be positive Swiss franc, in my opinion, because if you water down your own stance to give another victory to Trump, we may see Swissy continue to weaken. There will be, if they get a deal, it's probably going to we're probably going to see a bit of a knee-jerk reaction in Swiss franc because they have a deal, but it all will depend on how much it got watered down from the Swiss side. We have seen compare it to what we saw in the euro, and we've had this positive impulse on the euro signing a deal, but then everybody noticed and noted that it's not a good deal for Europe, but actually a very good deal for the US. And what happened to the euro? We lost quite a bit of ground. The Swiss is a much slower animal. We have been trying to get off the ground in Swiss for a long time, but I would say, depending on how a deal or a renegotiation would turn out, if it's again a victory for the US, we may continue to push a bit higher. I would say really watch this zone 80, 70, and we're above, down to 80 and a quarter. We really need to get back down below there to continue to push lower. Okay, that is kind of how I see this dollar Swiss right now. Euro Swiss still very slow, but we are now holding kind of supports. So again, there as well, I think the outlook for a deal would be that we see a bit of a reaction lower. Let me put it even on a shorter. I think if we get a deal, and for Switzerland, which is a little better because Switzerland gave in, we may see, sorry, a bit of a knee-jerk reaction higher in Swiss, lower in Euro Swiss, back to maybe 93 the figure. But then I think depending on what we will see out of that deal, it may be that we find the bottom again and start to go higher. So I'm I'm not a big fan, let's put it that way, of being short dollar Swiss right now. If I want to be short dollars, I may look at something different, okay? Maybe as we are seeing now, the correction ongoing, and that is what I was kind of expecting on my morning updates as well. A bit of correction lower in gold, and it's the same thing on virtually all the dollar pairs this morning. Digestion of that NFP. What were we doing before? Oh yes, we still don't want to be too short dollars, so it's coming down a bit. Still, it can go back to 33.45, and then we will have a look at what those the data are going to bring on gold. If we get like very strong data, and for instance that NFP, that employment component in the ISM being actually better than in last time, or better than expected. Imagine it to go back above the 50 line. We may actually trade all the way back down to 33 and a quarter or 33.10 even in gold before we look back. But overall picture, it's still, those jumps are still pretty impressive in my opinion. So anything negative should bring the bid back and perhaps going for that test of 3,400 in the end. And we're seeing virtually the same thing in all the pairs. Euro dollar is interesting because we saw this dump post that deal first of all, then another leg lower on the euro dollar. We stopped around the 50% of the move, which is also, if you draw a bit of a trend line here, which goes through tops and then a support here. We also stopped on that trend line. So 115.90, 95 is going to be pretty important if ever we get a negative print on the PMIs in the US. Can we get through 115.95 round it up to 116 if you want, and then for a look up at 116.5. But it is kind of interesting in the development of what we had the past sessions that we stopped right there. Okay, so this is a pretty decent level. Of course, the 115 is going to be a one to watch again, 114.85. But if you get a number which is better than the expectations, we could actually go all the way back down to 114.5. Why not? It does look that this market, apart from like the long termers who may still have sat on their hands, and as I said a while back, are we not just starting to form a new range somewhere? That is also possible. But as I said, it does seem that the market does not want to run too short dollars right now. So this is something that we need to keep in mind. Cable does roughly the same thing, albeit holding a little bit better this time than the euro, because euro sterling is a bit lower. But we are turning around this zone here, turning around at 133. Had a bit of a yo-yo here, 133. Yeah, we went a bit higher up to 133 and a quarter, 133.30. But I'd say 50.10, 50.20 or so around 133. That's the one to watch for as long as we don't break back below 132.5, or go and have a look at 133.65, 85. That's going to be a very important zone again. If ever we see weak data in the US and cable goes for a runner, watch out. This is, to me, a quite important zone once more, okay, if we would run up there again. One we need to take a look at, and we haven't looked at it. We've got the Kiwi employment report upcoming later, and that's just before midnight, London time. We've been trading below this channel. Try to get back into it, and that's around 59 and a quarter, 59, yeah, 2025. Okay. Watch on the labor report. After we will have, of course, a dollar move before, no doubt. But watch this little zone here. When we, if it's still valid over the Kiwi jobs report, 59.20, 59.30, and that should be the level that, if broken, we can start to gradually push up again. If not, if everything goes a bit array, or if we don't get a good impulse to sell dollars also on beforehand, we may be on our way back to 58 and a half, and who knows, even lower. So the jobs report is going to be pretty important as well for the Kiwi later on in the session tonight. Ozzy, are we starting to build a new channel? It is possible. For that to happen, it needs to hold 64 2025. Okay, on the Aussie, bit neutral here now. It is still, as I said, market is still reluctant to be too short in the dollars. We can see it on most of the pairs again. But we need to hold 64 2025. For as long as we hold 64 2025, there is a fair chance that we are starting to build a new channel. Okay, for that, if that's to happen, we need to go and really break above 65 in the sessions to come. US data, I don't know if we've got a lot of Aussie data upcoming. Not really in the next few sessions, but so it will be dollar dependent, risk dependent as well. But we need to break above 65 to get going, and then watch this one here. If it would break, then we may see a move back down to 63.5, 63.70. And looking at the clock, this is more than enough for today. Ryan, back over to you, mate.
Yeah, thank you very much, mate. Good stuff as always. We'll call it a day there for today. Thank you everyone for coming to the Flow Show and supporting us here. We will see you later on Face, and otherwise we will see you tomorrow. Have a great day, everyone.